This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to go through and look at a situation whereby instead of just one individual entity having control, what we have now is a number of entities that come together, each one with an ownership interest within another entity, and those ownership interests combined go through there and give you what we can refer to as joint control. So it could be that you have two entities that come together and own 50-50 shareholding within another enterprise. And that 50-50 holding gives us joint control. Now, what we have to have there essentially for there to be joint control is that there has to be a contractual arrangement, okay, or a contractual agreement in place that says if both parties come together, decisions will happen. If two parties don't come together, then nothing will happen. So what's going to happen in order to have this joint control? There needs to be unanimous consent. So a unanimous decision needs to arise whereby all parties agree, otherwise nothing happens. Okay. So what we need to go through and do there is we need to think about the types of joint arrangements that give you joint control under this accounting standard IFRS 11. Okay, so the way in which it could get examined is that there could be a small numerical aspect like we see in the example at the end that appears maybe in, say, question number 1, part A, as part of your group accounts. Alternatively, there's nothing to stop the examiner throwing it in as maybe a question 2 or a question 3 that talks about the different styles of joint arrangement, whether that's joint venture or is it a joint operation, and how we go through and account for either of them. Okay, so what you've got there, first of all, we'll go through there and talk about a joint venture. The key bit about a joint venture as part of a joint arrangement is, again, you have 2 or more parties, so it could be 3, each of which owns, say, 33 1/3%. And what they do is that they go through there and set up a new separate entity. And that new separate entity legally exists as a separate company. Okay, and each one of the venturers has an ownership interest within that other business. Okay, the key bit is as you have a separate entity set up, which is the key to spotting a joint venture, what you have there is you have the rights to the net assets. Essentially, you have an ownership interest, don't we, with regards to shares, and that ownership then represents the net assets, doesn't it? But the key bit about a joint venture is that you form a separate entity. So maybe you could have 2 previous businesses, maybe one that goes through there and can operate mobile phones, another one that has got music technology. And what you could go through and do there is that they could go through and set up a separate entity that incorporates mobile phones with music technology. Okay, so way back in the past, we had Sony, we had Ericsson. They set up a separate joint venture, which was referred to as Sony Ericsson, and they produce your Sony Ericsson mobile phone handsets that also incorporated the pretty old now, I suppose, MP3 style of music system that was on those mobile phones. Okay, key bit there is that Sony and Ericsson had joint control over what happened within Sony Ericsson. There would have been a contractual arrangement. Maybe they own 50-50. Doesn't necessarily have to be the case. It could be 60-40. So just be aware, 60-40, if there is a contractual arrangement that says we have to have joint control, then it is a joint venture. It is not a parent subsidiary relationship for that 60% holding. So do be very, very careful there. If you have a joint venture, key bit that you are going to have there is that you don't have control, so we can't consolidate. So you sort of have like a little bit of influence, don't we? Okay, you can't pass any decisions. You can't force people to take on board your idea, but you can block things happening, can't you? Because it has to be unanimous consent, doesn't it? Everybody has to come together. If one party disagrees, they can block the motion. So you do have quite a bit of influence. You have significant influence, maybe a little bit more than significant influence, don't you? So what we're going to do there is we're going to account for it exactly like an associate with regards to your equity accounting. Okay. A joint operation Essentially, there it is whereby there is no separate legal entity that is created. So it does tend to happen maybe in the oil and gas industry. Maybe what you've got there is that one business has got an oil well, maybe in the deepest, darkest areas of Russia, and we need to get the oil from Russia through a pipeline into Europe, into Africa, wherever that may be. So maybe one company owns the pipeline, one company owns the oil well. So what they might do there is they might set up a contractual arrangement that goes through there and says, look, well, I own this asset, you own that asset. We will share the assets, each individual one of us, and then whatever revenues and costs are incurred, we will share those revenues and we will share those costs out in relation to our percentage holdings. So that there's no separate legal entity that is set up. Essentially what you have there, instead of the rights to the net assets, you have the rights to the assets and obligations to the liabilities. So we're talking about your assets, the right to your assets and your percentage ownership of it, and we're talking about your obligation to the liability that maybe you have created. Okay, it's not an ownership interest in the net assets of the entity. Okay, you have specific ownership of an asset and a liability, of which that is then shared out. Okay, the accounting treatment here is everything to do with your share. So you record your share of your assets and liabilities, and then you record your share of revenue and costs in your statement of profit or loss. Okay, so very much different, if you like, to equity accounting. Okay, here you're just going to record your assets and liabilities on your SFP, so what you own, and then what you generate from that shared ownership, you will show there as your share of the revenue and your share of the costs. Okay, and essentially that's it. There's nothing else to it. However, when you play around with the numbers, sometimes they do become ever so slightly more complicated. But what I'd do there is just take a quick look, check that you're happy with the joint venture, whereby you have a separate legal entity that is set up, for which we then equity account for that separate legal entity, and a joint operation whereby there is no separate entity that is created, and you just account for your assets and your liabilities on your SFP, and then your share of the revenues and your share of the costs in your statement of profit or loss. And then what we'll do in the next little session, we'll go through there and play around with the numbers.